Buy a cruise line, get paid every time someone books a vacation, whether you're at sea or asleep in your own bed. That's the pitch. Here's the number it skips. A single new mid-size ship costs $700 million to build, before you've sold one cabin, hired one crew member, or paid a single port fee. In 2022, one of the most decorated luxury brands on the water, 17 straight years voted the industry's best in its own readers' polls, went from award ceremony to a ship fleeing a U.S. arrest warrant in about 6 weeks. That's not the exception in this industry. That's how it works. Here is what this actually costs. A new mid-size cruise ship costs $500 million to $1 billion to build, and it comes from a handful of specialized European shipyards: Meyer Turku in Finland, Fincantieri in Italy, Chantiers de l'Atlantique in France. There's no negotiating that down much. There are only a few yards on Earth that can build one. For a real mainstream mid-size ship, call it $700 million. That buys you one ship, not a cruise line. Then the systems nobody mentions in the brochure. Every vessel needs SOLAS-certified fire suppression, redundant navigation and lifeboat capacity for the full passenger and crew count, ballast water treatment, and increasingly, exhaust scrubbers or LNG fuel systems to meet international sulfur limits. None of it is optional. These systems alone routinely add tens of millions to a new build. Add flag state registration, classification society certification, insurance bonds, provisioning for the first sailings, and marketing to launch a brand nobody has heard of yet. And the honest total for getting one ship into the water and selling its first cabin comes in north of $750 million. That's before a single guest has checked in. Cost per berth on a new ship runs $100,000 to $350,000, depending on how luxurious the cabins are. Buying a decade-old second-hand ship instead can cut that new build number by more than half, but you inherit an older engine, worse fuel efficiency, and a shorter runway before your own dry dock bills start. Now the costs that run whether the ship is full or half empty. Crew comes first. A ship this size carries roughly 1,000 crew. Industry compensation data, including benefits and repatriation costs, puts average all-in crew cost at around $58,000 a year per person. That's $58 million a year, and it doesn't shrink in a slow season. Crew are contracted to the ship, not the passenger count. Fuel is next, and it's volatile in a way we'll get to. At a blended price of about $600 a metric ton, and a ship burning roughly 200 tons a day across 350 operating days, that's $42 million a year. Port charges and government taxes run about $20 million a year across a full sailing schedule. Food and beverage for passengers and crew combined, $19 million. A maintenance and dry dock reserve. Every ship needs a multi-million-dollar dry docking every few years whether you budget for it or not, $4 million. Marketing and travel agent commissions, still how most cabins get sold, $24 million. Insurance, hull, liability, medical, $10 million. And remember that number, because it only moves one direction. Freshwater and wastewater treatment, satellite connectivity for thousands of guests expecting Wi-Fi, and the booking and reservation technology that runs the whole operation add another $6 million a year. Infrastructure a hotel on land never has to think about. Add debt service on the ship you just financed, and general overhead, and the honest annual total is $246 million a year, before a single ticket counts as revenue. Here's how the money actually comes in. Industry-wide 2025 data puts real per-passenger spending at $286 a day, $193 in cruise fare, $82 in onboard spending on drinks, excursions, spa, and gratuities. That's the current market rate, not a best-case number. Now the volume. A 2,500-passenger ship running 57-day sailings a year carries about 125,000 passengers annually. Multiply it out. 125,000 passengers times 7 days times $286 is $250 million in annual revenue. Subtract the $246 million in operating costs from Section 2. $4 million is what's left. On $250 million of revenue, sitting on top of a $750 million investment, that's a margin of about 1.6%, thinner than a supermarket's. And it assumes every cabin sold, every port called on schedule, and nothing going wrong for an entire year. That $82 a day onboard figure matters more than it looks. It typically carries a far higher margin than the ticket price because the ship, the crew, and the fuel are already paid for the moment a guest steps aboard, which is exactly why every cruise line pushes drink packages and excursions so hard. Nothing going wrong for an entire year almost never happens in this industry, and the thing most likely to wreck it first isn't a bad guest or a bad crew. It's a cost you don't set the price of at all. That cost is fuel, and the ship doesn't get a vote on what it costs. Marine bunker fuel is tracked daily by independent price indexes. In the first months of 2020, as the pandemic crushed global demand, the average price across the world's top refueling ports fell to about $511 a metric ton. By 2021, as trade recovered, the average climbed to $544. By 2022, it averaged $871.50. And on June 14, 2022, in the aftermath of Russia's invasion of Ukraine, it hit a record $1,125.50 a metric ton. That's more than double in about 2 years, on the single line item that makes up one of the largest slices of your operating cost. Nothing about your ship changed. Nothing about your bookings changed. The fuel line from Section 2 can swing by tens of millions of dollars a year for reasons set by OPEC and geopolitics, not by anything happening on your ship. Ships that installed exhaust scrubbers to burn cheaper fuel grades weren't spared either. The price gap between fuel types that made scrubbers worth the investment hit $420 a ton in mid-2022, then collapsed to under $100 a ton within about a year, turning a multi-million-dollar emissions bet into a wash. Now picture a cruise line built to survive exactly that kind of swing, and rewarded as the best in the world for it, 17 years running. In 1988, Crystal Cruises launched as a quiet subsidiary of a Japanese shipping company. By the 2010s, readers' polls called it the best luxury line on Earth. In January 2022, its parent filed for bankruptcy. Within 3 weeks, one of its own ships was fleeing a U.S. federal court order. At its peak, Crystal Cruises wasn't a scrappy upstart. It was a 34-year-old brand voted the world's best large ship cruise line for 17 straight years by Condé Nast Traveler readers, and best overall for 16 straight years by Travel Plus Leisure readers. In 2015, its Japanese parent, NYK Line, sold it to Genting Hong Kong for $550 million in cash. The trigger wasn't Crystal's own operation. It was Genting Hong Kong's shipyard bet. 3 German shipyards bought in 2016 to build new ships for its cruise brands that collapsed into bankruptcy in January 2022, leaving the parent holding $2.78 billion in debt it couldn't service. On January 19, 2022, Genting Hong Kong filed a winding-up petition rather than risk a disorderly collapse. Crystal suspended operations days later. The spiral moved fast. On January 22nd, the Crystal Symphony, mid-voyage to Miami, with more than 300 passengers aboard, was ordered seized on arrival over $4.6 million in unpaid fuel bills. So the ship changed course for the Bahamas instead, letting passengers disembark in Bimini to dodge the arrest. It didn't work for long. On February 4th, the Crystal Symphony and its sister ship, the Crystal Serenity, were both formally seized by authorities in Freeport, crewed but empty of passengers. A brand with back-to-back decades of World's Best awards had ships under arrest within a single month. This wasn't bad service or empty cabins. Crystal was, by every guest-facing measure, still excellent. This was a capital structure failure one level up. A parent company that bet heavily on shipbuilding capacity, right as a once-in-a-century pandemic emptied every ship in its fleet for the better part of 2 years, and had no room left when the bet went wrong. The name didn't stay dead. A travel company bought the brand and the 2 seized ships out of the wreckage and relaunched them in 2023. But as a much smaller operation, under entirely new ownership, with the original company's 34 years of accumulated reputation now attached to somebody else's balance sheet. Here's a cost that never makes it into a projection. What happens when the ship simply can't sail? A single canceled 7-day sailing, at 2,500 passengers and this video's $286 a day rate, is about $5 million in lost fare and onboard revenue. But fixed costs don't pause because the ship is tied up. Crew, insurance, and debt service alone run roughly $350,000 a day, whether you're at sea or stuck at a shipyard. Add the repair itself. A routine, unscheduled dry dock runs $2 million to $10 million or more, depending on what broke. And one propulsion failure at the wrong moment turns a normally profitable week into a loss north of $8 million once you count the cancellation, the refunds, and the fix. There's a risk sitting quietly underneath Section 2 that has, on one recent occasion, erased every other number in this video at once. It's the risk that the entire fleet stops earning simultaneously. It already happened. A year earlier, the industry had carried 29.7 million passengers and was forecasting 32 million for 2020. In February 2020, the World Health Organization linked over half of all COVID-19 cases outside China to a single ship, Carnival's Diamond Princess. 712 people aboard, 13 of whom died. Within 6 weeks, the 3 largest public cruise companies had lost the majority of their stock market value. In March 2020, the US CDC issued a no-sail order that, in various forms, kept ships out of American waters for more than a year. The industry's own trade association put 2020's total economic loss at more than $77 billion. The individual numbers are worse up close. Carnival's revenue fell 85% in a single quarter, with a $4 billion loss in 3 months alone. Royal Caribbean's fourth quarter 2020 revenue fell from $2.52 billion the year before to $34 million, a 99% collapse. Norwegian Cruise Line's full-year revenue dropped 80%, and its debt load hit $11.8 billion just to keep the company alive. These are the 3 best capitalized companies in the industry. That's what a single systemic event does to a business that looked unshakable a quarter earlier. Some of this gets easier with size. Spread a $700 million ship cost across a fleet of 30, and fuel and food contracts get cheaper per passenger. Marketing gets more efficient per booking, and lenders offer better rates to a company with decades of cash flow behind it. But other things get strictly harder. Bigger fleets mean bigger simultaneous exposure. When the whole fleet stops sailing, as in 2020, scale just means a bigger number burning every month. New ships come from a handful of shipyards with years-long order books, so growth is rationed no matter how much capital you have. And running a modern fleet increasingly means competing against companies that already own most of the market. That's not an exaggeration. As of 2026, the 4 largest cruise groups control roughly 79% of global deployed capacity, and Carnival and Royal Caribbean alone account for well over half the industry's passengers between them. Royal Caribbean Group alone made $4.3 billion in profit in 2025, nearly 3 times what Hilton Worldwide earned running hotel rooms that same year, despite Royal Caribbean operating far fewer rooms overall. At a certain size, you're no longer selling vacations. You're managing fleet-wide capital allocation against 3 or 4 competitors who already set the market. It's a different business entirely. 2 versions of the same year. Optimistic, full occupancy, 125,000 passengers. Full rate, $286 a day. No lawsuits, no mechanical failures, no fuel shock. Revenue, $250 million. Costs, from Section 2, $246 million. Net profit, $4 million. On a $750 million investment, roughly a 0.5% return on capital, and that's the good case. Realistic, a major booking partner responsible for a fifth of your volume ends the relationship over a commission dispute, 25,000 passengers, and roughly $50 million in revenue gone, while crew and debt costs barely move. A shipboard injury or illness claim settles for $9 million, well within the range these settlements actually run. One unscheduled propulsion repair costs $12.5 million once lost sailings and fixed costs are counted. Recalculate, that $4 million profit is now a loss of roughly $67.5 million in a single year. None of this is a stretch. With distribution and market share this concentrated among a handful of giants, a single booking partner decision made in someone else's boardroom can move a fifth of your business overnight. The difference between those 2 scenarios is 1 lost distribution partner, 1 lawsuit, and 1 broken engine. None of those are exotic disasters. All 3 happen to someone in this industry every year, and that's without mentioning a pandemic. So who's still standing? Mostly, the largest 4 companies, who now control roughly 79% of the industry between them. Independent mid-size lines have had a brutal run. Genting Hong Kong's entire cruise portfolio failed in 2022. Other mid-size operators folded in the same wave, and several smaller lines never resumed sailing after 2020. The cause was never described publicly as bad service. It was structural, too much fixed debt, too much dependence on continuous cash flow, and a shipyard or financing bet that left no cushion when revenue stopped, for reasons no single company controlled. The same pattern has repeated across this industry for decades. Smaller casualties rarely made international headlines the way a fleeing luxury liner did. The operators who lasted shared 5 habits, and none of them are inspiring. First, new ships ordered on a staggered schedule. never betting the balance sheet on one shipyard relationship the way Genting Hong Kong did. Second, cash reserves sized to survive a full year of near-zero revenue, not just a slow quarter, the direct lesson of 2020. Third, distribution spread across many booking channels, so no single travel agency or wholesale partner can sink a season by leaving. Fourth, maintenance reserves funded before profit is distributed, so a mechanical failure is routine, not a crisis. Fifth, itineraries spread across multiple regions, so one geopolitical flashpoint doesn't cancel the whole calendar. None of these make the business bigger. All five are why a company is still selling cabins in 10 years, which, in this industry, is the actual achievement. So, buy a cruise line. Get paid every time someone books a vacation. That pitch is real. For about a 1.6% margin, sitting on top of $750 million you financed, in an industry that lost $77 billion in a single year, within recent memory. The cruise line doesn't get paid for selling the dream. It gets paid if it's still afloat. Financially, when the next booking season starts. If breakdowns like this are useful, subscribe.